Welcome to the recap for January 7th through 11th. And what a week it was. Let's get to the dailies. Welcome to Monday, January 7th. And nice little update, especially for small cap stocks. Russell 2000 was up almost 2%, S&P 500 0.7%. And the bigger the stocks, the less they were up. But a decent little day with not really any news to speak of. The White House did come out and say tax refunds will be paid as normal, will be processed as normal, which is interesting because there aren't very many people working at the IRS right now. So I don't know, unless Trump is going to personally send them out, who's going to be actually processing these refunds. But it is a little bit of a big deal because by the middle of February each year, about $100 billion of refunds get processed. So it's not a tiny little chunk of change. Obviously, I don't think it's something that's going to move the markets or the economy any material amount, but it is going to annoy a lot of people if this shutdown goes on. So we'll see how fast it gets resolved. We'll see if this is just another case of the White House coming out with something that has nothing behind it. It's Tuesday, and nice little pleasant day. Not very much news. Tim Cook, CEO of Apple, is out there talking, saying Apple's going to do a lot in the health space, and they're not going to settle any lawsuits, and he sees a bright future, none of which was a surprise, but market just chugging along. Nice little day. It's Wednesday, and I could basically replay yesterday's recap, and nothing changed. Nice little update. Not really any news. Headlines were all about, well, two things. One of them was Trump and trade in the wall, and again, we'll ignore that. And the other one was the Fed meeting minutes came out. What you need to know about Fed meeting minutes is these are the meeting minutes from the meeting that happened in the middle of December, where they already had a press conference to tell us about what happened in the meeting. And if they're going to release the minutes a month later and not 30 years later, it's pretty unlikely that they're going to lie or make something up, or there's going to be some big hidden agenda in there. So lots of headlines were generated from it. I don't think we learned anything new. If you're surprised by anything that was in there, probably need to pay more attention during the press conferences or watch the recap videos a little more closely. There were a couple of interesting pieces. One kind of wonky, nerdy one was the Fed talked about how there might be some volatility on what they pay for interest on reserves or the Fed funds rate because of their balance sheet unwinding, which makes perfect sense. Kind of gives themselves a nice reason for having some rate decreases and saying that they're not backtracking, they're doing it for other reasons. I'll get into that more in the economic recap at the end of the week, but an interesting read. I'll put a link to the minutes just in case you've never seen something like that and want to check them out. It's Thursday, and in case you're wondering, I did not get lazy and just take the returns from yesterday and the day before and use them for today. That is actually what happened. So, little update, not much news. People are talking about the wall. People are talking about this and that. Not a lot of volatility. If we get a bunch more of these, people might forget that we're in a bear market. We'll see. Maybe we'll end the week with a big day. It's Friday, and no news, no moves, no surprises. Nothing happened. So, as you probably didn't need my help to figure out, you take a bunch of pretty decent days and you put them all together in the space of a week. It makes for a pretty great week. Absolute banger for the Russell 2000, up nearly 5%. So that's your small cap U.S. stocks. Large cap stocks, similar, really good week, 2.5% or 3%. Emerging markets, foreign stocks, same thing, 3 or 4%. Treasury yields at 2.7%. So that's up just a smidge from where it was and down from, we were over 3% for a little while there last year, but bond rates are down a little bit. Not a lot of news. I mean, Apple was in the news for a day, but it was just kind of a steady market, and you take like I said, take a bunch of average days, average little up days, and put them together, and it makes for a great week. So great week for the market. Not much in it though, not a lot of news, and the real juice is over here with the economy. And originally I thought that I would give a synopsis of Jay Powell's speech. And it was interesting. I'll put a link to it. Maybe probably not worth listening to. It was a lot of the same things he's been saying for the last few months, which is why I'm not going to summarize it here. But if you're interested in hearing him talk about where he thinks interest rates are going to go from here. Spoiler, he won't tell you. Oil, China tariffs, if you're interested in hearing him say that they're going to wait and see a bunch of times, watch the video. Otherwise, what I am going to summarize for you is Richard Clarida, so another member of the FOMC, gave a speech, and I'll link you to the transcript of the speech. It was really good, and I'm going to give you just some of the highlights here. So, as we begin 2019, the initial conditions for the real economy are favorable. Through the first 3 quarters of last year, GDP growth averaged 3.2%. That's high. That's good. Private sector forecasts, as well as our summary of economic projections, indicate that when data for the fourth quarter are released, they will show economy likely grew at 3% or perhaps a little faster in 2018 and for the year as a whole. If so, economic growth in 2018 will be the fastest annual growth rate recorded in 13 years. In terms of economic outlook, ongoing momentum heading into this year indicates that above-trend growth is likely to continue into 2019. If the economy continues to grow in 2019 along the lines that I expect, in July, the current expansion will become the longest in recorded U.S. history. So emphasizing how strong the underlying fundamentals are. And then he says, the labor market remains healthy, with an unemployment rate near the lowest level recorded in 50 years, and with average monthly job gains continuing to outpace the increases needed over the long run to provide employment for new entrants to the labor force. So 2 little pieces there, kind of slipped one in at the end, low unemployment and new entrants to the labor force. Then he says, in a welcome development, nominal wage growth is picking up, with most measures running now around 3% on an annual basis. And for the past couple of years, wage gains have been noticeably faster for lower income workers. That's really good. And that's a little piece of information that I haven't seen written up a lot. I'd love to know exactly what he's referencing, but wage gains for low income workers is great news. Then he says, with regard to labor supply, we've had a pickup in labor force participation among prime age workers. So that's 25 to 54. That is, at least for now, boosting the supply side of the economy. The participation rate of prime age workers has risen about 1.5 points over the past few years, which is, I think, quite a bit. Then he says, price stability, of course, is the other leg of our dual mandate. And PCE inflation, so PCE stands for personal consumption expenditures, and that's the measure of inflation that they use. They don't use what's called CPI, which is the other major inflation measure. Over the past 12 months has been running close to our 2% objective. That said, and notwithstanding strong economic growth and a low unemployment rate, inflation has surprised to the downside recently. Yes, it has. And it's not yet clear that inflation has moved back to 2% on a sustainable basis. So he's referring to the fact that after they raised rates in December, forward-looking estimates for inflation plunged below 2%. Not below 1.5%, but below 2%. These recent developments in the global economy and financial markets represent crosswinds to the U.S. economy. So not headwinds, he said crosswind. Interesting choice of verbiage. If these crosswinds are sustained, everyone knows crosswinds are the most dangerous winds to land a plane in. My pilots comment on this. If these crosswinds are sustained, appropriate forward-looking monetary policy should respond to keep the economy as close as possible to our dual mandate objectives of maximum employment and price stability. With our December decision, the 2 point, and I'm going to get a little bit nerdy here with this last one, but it's good. With our December decision, the 2.5% upper limit of our target range for the federal funds rate is now equal to the lower end of the range of committee participants' estimates of its long-run equilibrium level, also known as R star. So R star is what they use as shorthand for the long-run equilibrium level of interest rates. So think of it as like quote-unquote normal. One defines R star as the level of the policy rate that, if sustained, would maintain full employment and price stability in the long run. And then he says, and this is interesting, and you'll hear this said a lot, and this is where I think journos get it wrong a lot. They think R star is something that it's like a magical number, and if we find it, we've solved everything. As I have discussed in a previous speech, R star is both unobserved, you can't see it directly, and time varying. So it must be inferred from macroeconomic and financial data. And he goes on and on. Very, very good, very informative. If you want to know what the FOMC actually thinks, what they're actually thinking about, what they're focusing on, I think this is the way to see it. This is the window. So I'll put links to both of these. Check them out if you're interested. And for a little weekend reading for you, I give you plenty of economic stuff. I'll also give you the link to the Fed minutes that I promised you during the week. Last one, kind of interesting, kind of a change of pace. There's this idea in crypto, this weakness, this theoretical weakness called a double spend attack. And it's really interesting. And since the whole point of crypto is that it's supposed to be safe from like these very problems, these very issues, and this specific instance seems to be rearing its ugly head. Wonder what else is out there, what other problems crypto has that people haven't realized yet. But check it out. It's double spend attack, very interesting, and it's something that as soon as it's become kind of in the zeitgeist, as far as people know about it, it seems like it's actually happening. It seems like if you have some substantial crypto investments, you should figure out what you think about this. So I'll put that link below as well. That's it for this week's episode of Fed Watching. If you normally listen to this as a podcast, consider checking out YouTube, where there's visuals to go along with it, and some special bonuses only available on YouTube. So I got a couple videos of me going through and answering questions on personal finance Reddit, really just giving my unfiltered thoughts, first thing that comes to mind as I read them. Pretty interesting. Check it out.